Greetings, welcome to AssetTV Boutiques Connect. I am Zamazulu Zulu, and for this episode I'm joined by Gavin Wood, who is the Chief Investment Officer at Camissa Asset Management. Welcome, Gavin. Nice to see you.
Thank you.
So in this episode we are going to be discussing your three risk-profiled portfolios, the Camissa Stable Fund, Camissa Protector Fund, as well as the Camissa Balanced Fund. Maybe just as a start, how would you describe the investment objectives of these three portfolios?
Yeah, I think that what we think is very useful for investors is to think carefully about what risk posture they want to take. And that's almost the most fundamental investment decision that an investor takes. And then we try and cater for at least three categories of those. And then obviously we've got equity funds that cater for a higher risk posture. So from stable up to balanced funds, it's increasing risk postures that we're catering for. And so the objectives take that into account, take the fact that for a lower risk fund you have more modest objectives, return objectives. So for our stable fund, the objective is to beat inflation plus 2%. That's the objective. Clearly we want to do a lot more than that within the constraints, but that's the objective. And then the protector fund, we need to beat inflation plus 4%. And also we want to do more than that, but that's the objective. Now, very, very importantly, neither of those has the word competitor in the objective. So we are completely agnostic on those two funds about where we find ourselves in ranking tables, despite what people might see and put us there. So we're completely competitor agnostic within those objectives, partly because we don't know what the competition's necessarily doing, and that might conflict, what they're doing might conflict with what our objective is, which is to beat inflation. Then the balanced fund is the most high risk of our multi-asset class funds, and its objective is to beat the competitors. So its objective is to be in the top quartile of comparative balanced funds. And therefore it's going for a maximum risk posture within the multi-asset class sphere, within the constraints of Reg 28, and it's going to try and outperform the competitors handsomely through time. So a different objective that's not inflation related. We would think that that would translate into a very strongly inflation beating return through time. But those are the various objectives.
Okay, great. Thanks for outlining all of that. And I'm assuming you are most probably quite pleased by the recent reclassification of the ASISA categories that has now come into effect beginning of October, specifically with regards to the high equity funds where your balanced fund would feature, because your fund has the global exposure, but I believe you also have an SA balanced fund as well.
Yeah. So we've got an SA balanced fund and a global balanced fund, and the only difference between those two is the equity component, which clearly for the global balanced would have a mix of global equities that are not listed in SA and local, and the SA balanced fund has equities that are only local. And I mean, to the extent that, and that's at the moment, to the extent that we wanted to employ global fixed income or global yield assets as well, we could put those in, but at the moment that's the main difference is the equity side, and the yield asset side is completely the same. We've also got the same distinguishing feature in equities, and we've got an SA equity fund and an equity alpha fund, which has also got a bit of global in it.
And then just something that I thought was quite interesting, I looked at your top holdings in the three portfolios, and just looking at how you've selected the shares for the top 10 holdings in the funds. Lots of similarities, but the only big difference that I could point out were the weightings per stock. Is that by design, or are there other factors at play when you are thinking about the stock selection process for the three risk profile portfolios?
Yeah. So the way we run our investment team is to have one team looking at SA equities, and the same view permeating through all of our portfolios, whether they're pure equities or stable fund, or right the way along the risk spectrum. And global equities, likewise, exactly the same stock picks across. And then with fixed income or yield assets, exactly the same. So it's one view, and those are sort of building blocks. But you're right that as we go down the risk spectrum in the stable fund environment and that lower risk category, we're much more evenly weighted. And so in equities, the stable fund's much more even weighted across the equities that we are. The same stock picks, but much more evenly weighted. And a classic example is Naspers and Prosus, which is very big in our equity funds and is big in our balanced fund, but is actually it's a larger one, but it isn't proportionately bigger in stable fund. So much more even weighting. And then in the balanced fund, it's almost a perfect replication of our pure equity funds, the equity component. So, and then protector fund is somewhere in between. And the idea there is that one of the risk mitigating techniques and strategies we're deploying is diversification. And so in stable fund, we want a more diversified, less concentrated portfolio in any one particular stock.
All right, okay, no, thanks. That actually makes a lot of sense.
In the yield assets or fixed income component, there again, the idea would be almost exact replication across the three multi-asset class funds. So that's a lower risk category, and it's less about concentration. So the view there is very, very similar yield asset or fixed income exposure on a security selection level across those three.
Okay, and then just looking at your foreign exposure across the portfolio, so I think the big change that we've seen in Reg 28 in the past 2 years is around the foreign limits. How do you think about the foreign allocations in these three funds specifically, and have you maybe had to make any tweaks to your process since the change was made?
No tweaks to the process, so it's just really an ability it's less of a constraint, so it's an ability to have more global. That's how one should think about it. We've always thought of equities and sort of fixed income as distinct categories. Whether they are listed in SA or offshore, it doesn't change the characterization of what sort of asset class we're talking about, likewise on the fixed income side. So those are the key categories, and then what you do within those categories is dependent on your bottom-up view. So on the global side, to the extent that we favor our global portfolio, we would have more, and we now are able to have a lot more, up to 45%. And to the extent that in yield assets or fixed income we could do potentially the same, so that's really the only difference. So that doesn't change the process. It just changes your ability to have more. And at the moment we're not running to maximum in offshore, so we are running at a lot lower. And so yeah, we're not deploying that. We're not bumping up against that constraint, deploying that ability at the moment.
Okay, so let's just talk about downside protection, because I'm assuming that is relevant for the low equity as well as the medium equity portfolio. What hedging strategies do you utilize in these funds in particular, and any ESG considerations that are part of that process?
Yeah, so in terms of hedging, it's a permanent part of the stable fund strategy. So it's a key part, and it's a critical foundational part of the stable fund strategy, because the objective is so absolute, and we're obsessing about, as an objective, not having any downward movements over a 12-month period. We really are obsessing about downside protection, and we're prepared to let some of the upside or excess returns go in pursuit of minimizing downward movements. So we employ put option protection in that, and I can get into the details there. And then protectors somewhere a little bit less than that, and then the balance fund, it's from time to time. It's not necessarily a core part of the strategy, but it can be deployed usefully. And the way we think about it is it enables us, hedging in the balanced fund environment, enables us, and in the stable fund environment, to run higher gross exposure to equities, and therefore higher exposure to our ability to generate alpha in equities, which we think is the area where we can generate the most alpha, and where that's a market neutral ability to have hedged equity that is generating alpha and giving you cash returns is a useful addition to a balanced fund strategy. So that's in the balanced fund, that'll be used from time to time to enable us to have higher gross equity exposure. And in the stable fund environment, it enables us to permanently run higher gross equity exposure without running the risk of volatility and downward movements in equities. So that, and then protectors somewhere in between. So that would be the key. I think that the other key thing, and it's sort of related to hedging, but it's more just relating to hitting that risk profile, that risk posture that we're wanting the investor to adopt, is the actual asset allocation. So clearly we've got in those three categories, we've got a CISCA constraint. So in stable fund it's 40% maximum in equities. In protected, 60% maximum in the medium equity, and then in balanced fund, it's 75% maximum in equity. So that's the one constraint we have. And then the other is internally in terms of strategy, we're running on average a range within the balanced fund of 65 to 70% in net equities. So on the higher end of the permitted range, because we believe that that is the way of generating superior long-term performance for the balanced funds. And then in the protector case, it's a slightly wider range. It's more like 35 to 50% is the general range we would run in net equities, and then in stable fund it's 20 to 30%, not on average towards the top end of that we'd be running in terms of net equities. So it's that mix of fixed income and equities is another key part of achieving the risk profile of those funds, which in addition to hedging. And then you touch on ESG and those considerations. There's nothing in our mandate or nothing in our objectives which refers to ESG. Okay. So it's not, we're not screening in terms of anything to do with those sort of considerations. The way we as a team view ESG and those sorts of sustainability considerations is that they are part of considering risks in the investments we make. So to the extent that an environmental issue is worth considering as a risk for our sustainability of what we're investing in, we're very much focused on the implications of that for the long-term future of a company. So by way of example, a company like Exxaro, which is a coal producer, coal miner, we would think about how long they're going to be able to have clients who are going to be using coal, how long those power stations are going to be working for, whether they're going to be carbon taxes imposed, and those sorts of considerations rather than should we invest in a coal mine or not. So it's a sustainability issue rather than a moral issue. The moral issue we leave up to the regulators and the country's framework within which we operate. And then, for example, on a governance issue, we would be very much thinking about, let's say, executive remuneration or board control or capital allocation decisions very much as part of the risk management and risk mitigation within that investment. So we'd be very active in trying to think about problems that we see there and steer clear of companies we think are permanently problematic, or try and change and influence as an activist the risks that we see within a company. So that's our stance. It's part of our process, it's part of our research, it's part of the value we add to our clients, but it's not a sort of a moral screening one way or the other. That's a separate category of funds I think that investors could be looking for.
Okay, fabulous. Okay, that all makes sense. You referred to the ranges from an equity allocation perspective. I'm just curious. I mean, next week we have big elections in the US taking place. I understand it's a binary event situation. Would that maybe result in a slightly lower, I mean, have you made any tactical changes to your asset allocation in anticipation of that?
Yeah, no, generally not. So top-down sort of considerations like that are generally something we try and stay on top of and try and think about the implications and try and think of the stock-specific or yield asset or fixed income specific, interest rate specific implications or currency-specific implications of some of these things as background to what we're really doing. What we're really doing is building portfolios from the bottom up. But I think I would say that A, we don't know what the result is going to be. One can have a view. B, we can guess, but we don't really know with much certainty what their policies would be, despite what they say. Sometimes they don't do what they say or are unable to practically implement. And thirdly, and most importantly, we don't necessarily know what markets are already anticipating and what's already in prices and what could actually happen in market pricing if it goes one way or the other. So I think it's a very fraught exercise to have an investment process that revolves around that. So we generally are steering clear of these short-term developments. We're trying to think about longer-term, like let's say China-US relations, whether it's the one president or another, or the future dispensation or future presidency 4 years hence. So I think those are much more important considerations, is to just generally think of the long-term trends and dynamics that are going on in the world and how that would impact. because I think that's much more important than the shorter term dynamics of what the Fed's going to do next, and whether they're going to cut by 50 bips or 25 bips and when, and what the impact on markets would be of all of those things. It's all reasonably unknowable, and we don't know what's already in the price, and likewise with presidential elections. So we're not generally steering clear of tactically doing anything around shorter term events and news flow.
Okay, no, that's very clear. And then in terms of alternative asset classes, because I'm just thinking Regulation 28 caters for that, and I saw in your stable fund in particular, you have a small allocation to commodities. How do alternative asset classes make an appearance in these funds?
Yeah, so I think that there are very few alternative asset classes really available to a unit trust in South Africa. We're not really able to participate in unlisted investments or securities, and I think we're limited to what's listed. So that's the first thing to say. The second thing to say is, generally, I think our view on asset classes is there are only really two. It's really sort of ownership asset classes and fixed income or sort of debt type asset classes. And things like infrastructure and a number of fashions at the moment about what could be a different asset class. They're all variations on one of those two themes. Either ownership, where you participate in the residual, there's no fixed return promised, but there could be a lot of upside, also there could be a lot of downside, a lot of risk potentially. And then fixed income or debt, where you are lending, there's no real upside, and what you really want is just to get your money back plus the returns that are promised. And those two are very different, and I think most asset classes can be fitted into one of those two in one form or another. But as you say, the one that is a bit of a difference is commodity. So we are able to invest in listed ETFs which contain commodities. So one could potentially invest in a gold ETF. One could invest in, there's palladium, there's rhodium, there's platinum, which are various ETFs, and there are a couple of others that one can get globally that are commodity type ETFs, and that's a very different asset class. So one of the strategies we deploy, in particular in the stable fund, but also across others, is to try and diversify across asset class and diversify across stock selection as much as possible as a risk mitigating measure within stable fund. So we have got a 3% position in the platinum ETF at the moment, and we just think the platinum price, for a variety of reasons, is likely to be going up and should be higher than where it is now. And the main reason is that platinum miners are not covering their costs at this platinum price. So they either have to go out of business or cut back on production, or the price has to go up to enable them to make a bit of a profit margin. It's not sustainable. So that's the one aspect of it. The other aspect is that the platinum price is set in dollars. So to the extent that one wants to have a bit of a sort of anti-rand or dollar view on an asset, we'd invest in commodity. So that commodity investment that you identify is 3.2% or odd. It's quite small, but it is a diversifier, and it's in the platinum ETF at this stage.
Okay, all right. So then, is that your preference? I just want to make sure I understand. So do you have platinum miners as well as this platinum?
Yes, we do.
ETF? Okay.
Yeah. But a lot less in terms of platinum miners in the stable fund, and a bit more of the metal, whereas in the balance fund it's much more on the platinum miners, the more risky side, the more volatile side of things, and no platinum ETF at this stage.
All right, okay. And then the reason for that, just to make sure that I understand and our viewers understand, is for your low equity portfolio, the stable fund, because you have that serious capital preservation objective, you want to incorporate as many uncorrelated asset classes in order to help you mitigate the downside.
That's exactly right.
Fabulous.
Exactly right. And on the diversification point, you put it much better than I could have, and that's exactly right. So the idea is that we think that the risk and return characteristics of the commodity ETF, the platinum ETF, fit very neatly into the stable fund. I think there's very limited downside and quite substantial upside, but not as much as in the miners, and the path to get there will be less volatile. And it's very uncorrelated, as you so well put, to other asset classes.
Okay, excellent. Yeah. I think we'll leave it at that point, Gavin. Thank you so much for your time and for outlining the differences in your three multi-asset portfolios at Camissa. And thanks to our viewers. Keep well.
Thank you.
Cheers.